Welcome, everyone. This is Brad Ward, Director of Community Philanthropy here at the Council on Foundations, and welcome to our webinar this afternoon on Top 10 Questions from the Council's Legal Matters for Community Foundations workshop held recently in Dallas, Texas. We're delighted that you've joined us for this webinar, and I am happy at this point to introduce the folks that will be on the call. I've introduced myself as well as my colleague, Brian Del Rosario. Brian is our legal counsel with the Council on Foundations. Many of you know him from all of his late mornings, late nights, answering your emails and your phone calls about various questions dealing with community foundations. He is going to be leading today's session, and he's going to be helping us walk through some of the top 10 questions that were dealt with at the Legal Matters workshop. Wanted to remind you that these workshops are great opportunities to convene with the council in person. Aside from all the various events that we do, the events specifically around legal matters are held in 5 different locations across the country. We had Dallas in April. We have Milwaukee, Wisconsin coming up on June 28th. We have one in Raleigh, North Carolina in July, Hartford, Connecticut in September, and we're very close to launching the registration for our Spokane, Washington event on October 11th. Each of these events are very cost-effective and affordable events for you to send your staff so that they can get some of the top-tier basics as well as the deep dive into legal questions and legal issues that affect the work that we do at the Community Foundation. As many of you know, there's no other top-tier and strong level of provider when it comes to legal affairs than our own team here at the Council on Foundation, simply because of the breadth and knowledge that they have working exclusively with foundations and particularly working with community foundations. Many of you know they deal with over 2,000 requests for information a year, and they are addressing questions on a daily basis from our colleagues and your peers from across the country of all different shapes and sizes, community foundations, questions that range from how to take on gift acceptance to fund administration to particular grant making. So their depth and their knowledge, you just don't have an entire day spent with this kind of qualified legal attention anywhere else in the country. And so we're happy to be taking those workshops on the road, aside from all the other great events at the council. At this time, I don't want to waste any more of your time. I want to jump right in and turn things over to Brian Del Rosario, who's going to be here to talk through these top 10 questions. If there's time left over at the end, we'll gladly moderate a few questions from all of you by sending those questions through the question box. So Brian, at this time, I'm going to turn it over to you.
All right, thanks, Brad, and thank you everyone for joining the call. And because we are doing a legal webinar, first have to provide you with this disclaimer that this is not legal advice, and obviously we cannot provide legal advice because we're not licensed in every state. But before I also go further onto this webinar, Brad consistently throws attribution and praise to legal, but that admiration and gratitude goes both ways. I lean on Brad's expertise and experience in the community foundation trenches to give me context of how legal principles and standards interact in a real-world setting. So Suzanne and I respond to legal questions, but Brad provides the council legitimate street credibility given his expertise and experience in this field. So let's go forward. And here are the subjects that were addressed in the Dallas convening. Now, a word on this webinar relating specifically and generally about these new legal matters offerings by the council. These workshops do not have a set curriculum. So if you've attended or listened to one legal matters, you've attended or listened to just one legal matters. This presentation is based on the Legal Matters workshop that was held in Dallas on April 2nd, and a couple of weeks before this event, Suzanne Friday, who has a conflict today because of the Georgetown Law CLE event sponsored by the council, but who otherwise would have loved to do this webinar, sent an email to the participants of this workshop inquiring them of the topics they'd especially wanted to engage in at the workshop. And these slides reflect those interests and concerns raised by the Dallas attendees. As you can see, one of the big issues here was the Tax Reform Act 2017-73, that notice from the IRS and Treasury regarding donor advised funds, and common grant making issues such as grants to non-charities and fiscal sponsorships, and et cetera, et cetera. So let's, with that, let's take away with the first question here that Suzanne answered. Now, what is the big takeaway from the Tax Reform Act? So the 2017 Tax Cuts and Jobs Act, that's what it's actually called, and an interesting note is that the name was dropped due to a legislative procedural issue, which now is just called HR 1. It became law on December 22nd, 2017. So let's go forward here. And as you can see in green, the check box there, check boxes or the checks are basically some of the issues that we will see. So it impacts tax-exempt organizations in a variety of ways, including by reducing incentives for charitable giving, creating tax silos for each line of unrelated business taxable income producing businesses, and characterizing taxable income for fringe benefits as UBIT. Okay, so let's get into these first. So the first check there is the lowered individual income tax rates. What I should make note there is that this is temporary. So the act reduces the top marginal tax rate from 39.6% to 37% for taxable years beginning after December 31st, 2017 and before January 1st, 2026. And as I mentioned, this is temporary. So generally, a reduction in the top marginal tax rate would decrease the value of charitable contributions for highest income taxpayers, thereby reducing the tax incentive to contribute. The second check there is increased standard deduction. Again, this is temporary. And so while the deduction for charitable contributions remains in place, taxpayers have to itemize deductions to claim a charitable contribution deduction on their federal income tax return. So the number here that pundits and attorneys have been throwing around is about 94%. An estimated 94% of taxpayers are now expected to claim increased standard deductions, up from the approximately 70% under pre-act law. So these 94% of taxpayers are expected to have no tax benefit from their charitable giving. So going back, prior to this law, an individual who does not itemize deductions could reduce their adjusted gross income, or AGI, by the standard deduction. So let's take a look at some numbers. In 2017, the amount of basic standard deduction was $6,350 for single individuals and married individuals filing separate returns. Today, that number is $12,000. In 2017, it would be $9,350 for heads of households. Today, $18,000. And then finally, $12,700 for married individuals filing joint returns. Currently, now, it is $24,000 for married individuals. So as you can see, those amounts nearly doubled. The fourth and final check mark there is the double threshold for estate taxes. And basically what the act did was it doubles that estate and tax gift exemption. And by increasing that exclusion amount, which is provided in IRC 2010-C3, it went from 5 million to 10 million. So what this means is by increasing the exclusion, it is expected to reduce tax incentives for the wealthy individuals to make deductible charitable requests. So there's really not much of a incentive for them to do that. Moving forward, number 2, will UBIT changes under tax reform affect my foundation? And the answer here is possibly. So let's look at what is in the legislation. The first check there is regarding the UBIT silos and the computation of UBIT. So prior to the law, tax-exempt organizations that operated multiple unrelated trades or businesses historically were permitted to aggregate income and expenses and other deductions from all unrelated trade or business activities. So what this did was it would allow these tax-exempt organizations, including community foundations, to use net operating losses, or NOLs, from one unrelated trade or business to offset UBIT from another, thereby reducing the UBIT overall. Now, the changes here is that the Act now requires these exempt organizations operating one or more unrelated trades or businesses to compute UBIT separately. Okay, so for each unrelated trade or business activity. So these net operating losses from one line of business will not be available to offset taxable income from another. What I have to make a point here is this is all regarding unrelated business income tax, or unrelated income that comes from the services that are not related to your foundation's mission. So if you do not have UBIT, then this is nothing that, or something that you wouldn't have to worry about. But if you do, then this is something that I'm sure that your accountants and your finance department are talking about a lot about here. The inclusion, the second one is the inclusion of certain fringe benefits in the calculation of UBIT. So under prior law, tax-exempt organizations could provide employees with certain fringe benefits that were free from tax at the employer level. So the employers would not be paying taxes on these levels. Today, the changes in this tax law is that the Act treats the amounts used by tax-exempt organizations to pay for certain fringe benefits offered to employees as UBIT. And as this list shows, the triggering fringe benefits include the qualified transportation fringe benefits, any parking facility used in connection with the qualified parking, and on-premise athletic facilities. The implications of this change is that from a tax policy perspective, this provision that affects tax-exempt organization is basically an attempt to create parity with another newly enacted provision that is applicable to taxable organizations, which eliminated a tax exemption for certain employer-provided fringe benefits. So given this change, tax-exempt organizations providing these types of fringe benefits to employees will be required to pay a corporate tax rate on the value of such benefits. Now, one of the things a lot of attorneys and accountants have been looking at was what can tax-exempt organizations do in this regard to kind of work in this space. And so what a lot of attorneys and accountants have come to realize is that these organizations may wish to consider replacing these benefits with higher compensation or other benefits of equivalent value to their employees, but which do not trigger UBIT. And finally, this was effective at the beginning of this year. Okay, moving forward. So did the tax reform make any changes to the rules about political activity, which is the Johnson Amendment? And as you're aware, the council was pretty much on top of this and had a lot of resources, and our policy team was deployed constantly to the Hill to talk about this. And no, so there's no changes there, and this basically, the slide that you see is the only guidance that we have thus far. I will leave this here, and I think you will have access to this slide deck. But since there's nothing new regarding the Johnson Amendment, I will not go any further on there. So moving forward, and now we get into the more community foundation's substantive issues. And as you can tell, 2017-73, this notice regarding donor advised funds was a hot topic for a lot of community foundations because they are the sponsoring organizations of donor advised funds. So let's talk about the treatment of pledges under the new DAF guidance. So here we go, the pledges and DAF distributions. As you can see here, the underlined portion is that it need not determine, the community foundation or the sponsoring organization need not determine whether a donor advisor has made a pledge before sending a DAF. And so the way that a lot of people have described this is a quote, a don't ask, don't tell policy on the part of the community foundation. But as you can see, there are provisos or conditions attached there too, because it says that even if it turns out that the donor did not make a pledge to the charity, if the following conditions are met, which go on to the next slide. And here are 3 conditions that that the IRS and Treasury has put forward addressing pledges. Now, what I have to say is that generally there are various ambiguities in this notice, as well as a lack of clear rationale for certain of the administrative requirements included in the notice. But let's go through these. So number one, the first condition is that the sponsoring organization or community foundation makes no reference to the existence of a pledge when making the DAF distribution. Number two, the donor advisor receives no other benefit as a result of the distribution. And number three, the donor advisor does not attempt to claim a second tax deduction for the distribution to the charity. Now, a couple of opinions on my part here. Number one, I think is a little unnecessary, and I'll go through that. Number two and three are a little more self-explanatory, and I'm generally on board with these. But what I want to do is bring your attention specifically to that space between number two and number three. There's that semicolon and. And from a statutory interpretation point of view, what that means is that it is these conditions are read in the conjunctive, which means that all three must be satisfied to meet the condition that it is not a pledge and it's not being used as an incidental benefit. Now, going forward, number one, as I mentioned, I think this is a little unnecessary. The makes no reference to the existence of a pledge. What I think of it is it's akin to that sleepover game as a child where you try to invoke the spirits of the Sandman or Bloody Mary in the bathroom mirror. You know, these are like at the sleepover games. Unfortunately, my mom never let me sleep over or go to sleepover parties, which typically were held at David's house because he had a VHS copy of The Sandlot, which I was told continuously and repeatedly was played in the background. If they had not yet gathered the requisite courage to call up our collective sixth grade crush, Allison Talrico, they had played this game. So going back, this game is they invoke the name of the Sandman or Bloody Mary just by saying it, and it's nothing about like these spirits would come. It's just the fact that they said it, and so that's why I said there's a problem here. There's a formalistic requirement here that says that they cannot make reference to the DAF, but that formalistic requirement does not appear, in my opinion, to address any substantive concern as to the character of the distribution. So what I don't understand is how whether or not the community foundation refers to the pledge affects whether the donor advised fund distribution constitutes an incidental benefit. What I think is important here, and what Treasury and the IRS need to do, is they would need to, and I don't know if Brad, you agree with this, is that they would need to, if they put this in place, they would need to define what reference to a pledge means. Because, for example, and Brad, you might have some insight into this, but community foundations, from what I understand, often describe the purpose of a grant in a transmittal letter, grants for special projects or which involve the provision of naming rights for donors or advisors may be subject to detailed conditions. These detailed descriptions of a distribution's charitable purpose serve a vital role in ensuring that grant funds are used by grantees for the intended charitable purposes. But here, the notice does not make clear whether such descriptions could constitute indirect references to pledges and thereby violating the first condition here of this notice. So I don't know if you have a comment on that, Brad, but I just think that if they were to have number one, maybe they should define what that reference to a pledge means.
Yeah, you know, I've always been a little bit challenged on this particular. I mean, a lot of times I think it's fair to say that we don't always know the full nature and intent of grants to particular charities because it doesn't quite meet the level of criteria where we're over scrutinizing it, or it's with a trusted entity that we already support at a community foundation, whether it be the local museum or the theater or the university. The challenge is just by nature of those three examples, I think all of us recognize that there might be a perceived benefit of association, you know, with tickets, for example, at the theater. I think you're right that asking for what is in reference to the pledge helps you avoid the creation of just blatant, disregard for the rules. That being said, Well, how else would you take that? I just think that, I think you and I both know that this is a very slippery slope and it's a tricky space for us. I don't interpret the rules to say that the IRS is as worried about incidental benefit, but if you're
Right.
talking in the multitudes of thousands, and particularly with universities and college sports, that really starts to send off some red flags. I think it's a little less gray if it's smaller amounts in the lower thousands or hundreds, and it's perhaps very incidental associated with the theater or museum.
All right. Thanks, Brad.
Yeah.
Number two, the donor advisor receives no other benefit as a result of the distribution. Well, this one, as I mentioned, was self-explanatory because it is consistent with IRC 4967. And as you may know, IRC 4967 is the section on donor advised funds that states donors, donor advisors, or related persons may not inure to a, quote, more than incidental benefit. So in that regard, number two is fine. Number three, I also think that this is generally okay. The donor advisor does not attempt to claim a second tax deduction for the distribution to the charity. So what we know is that donors are able to claim a deduction at the time of the contribution to a community foundation. So following this donation, this initial donation, the donor is no longer able to claim a tax deduction on those assets, because under the Treasury Regulations 1.170A9F11, those are the component fund rules or regulations for community foundations. The community foundation now has the complete dominion and control over those gifted funds, and therefore the donor does not have any legal claim to those funds. So he or she cannot claim the charitable deduction when a DAF distribution is made. But here's where I have a little bit of an issue. So I do not think that the sponsoring organizations or community foundations should be expected to do more to ensure compliance of third parties, such as donors or advisors or other charities. Now, this is just my own opinion, but indeed there is little, what I think, and as Brad intimated, there's little a community foundation can do to police the actions of grantee organizations that may send acknowledgement letters to donors or advisors. Because here's how it works. The consequence for claiming an impermissible charitable deduction simply is a loss of that deduction and any applicable penalties and fees that the IRS may impose on that individual taxpayer who took an impermissible tax deduction. But I believe that should not involve any consequence to the donor advised fund or the community foundation. But as I mentioned, these are just the three conditions that are connected with the pledge issue that 2017-73 addressed. And I believe that while the IRS and Treasury cut off comment or had a deadline of, I want to say May 5th or March 5th for comments to 2017-73, I have been hearing through the grapevine that the IRS, and correct me if I'm wrong, Brad, but the IRS is still accepting comments to 2017-73. So your guess and the community's foundation's guess is as good as mine when these actual rules or regulations will be promulgated.
Well, and I think it's fair to say that we waited a long time, I mean years, when I say long time, before they even accepted opinion on it, and they provided even the basis of clarity that they recently provided. So yeah, I think it's fair to say I do believe that comment is still being accepted. We certainly already submitted ours on behalf of the field, as did other entities and national standards and other organizations or other voices were consulted in that process. But unfortunately, you're absolutely right. We have no idea when the next phase of iteration of clarity will come.
And that's a great point, Brad, because 4966 and 4967, the sections on donor advised funds and the incidental benefits and prohibited benefits for DAFs and DAF grants, that was given to us through the Pension Protection Act of 2006. So if you can remember how many years have passed since our concerns have been addressed regarding donor advised funds, but I guess we can wait a little bit longer. Now moving forward, there is this line here in 2017-73 that addresses the pledges, which states that taxpayers may rely on the rules described in Section 4 until additional guidance is issued. So what that means is that the IRS is telling foundations and sponsoring organizations of donor advised funds that, yeah, you can rely on 2017-73 now with respect to pledges, but as Suzanne put there on this slide, cautions not to interpret this as a green light to begin paying donor pledges with donor advised fund funds. That just means that until we get further guidance, we could sort of, kind of, maybe rely on 2017-73 that states that if we don't say it's a pledge and if the donor doesn't take an additional tax deduction, then the donor advised fund can make that grant.
Brian, I was just going to jump in real quick on that. You know, one of the best incidents that I've heard for community foundations that they've just tried to clarify that donor advised funds are for true grant making towards towards charitable projects and charitable purposes, and tried to distinguish tried to be very clear and distinct that donor advised funds are not the vehicle by which one should pay anything that might be above and beyond a true charitable project, and might be associated with a membership or anything that is convoluted in that way, and instead use your own personal checking account and get the more immediate tax benefits from that. That's been a way to clarify, as a way to try to stay out of this gray area that is not overly clear from the IRS, but it gives us enough clarity that this is a red flag for them.
Right. Great point, Brad. Great point. And what I also tell members is that make it a habit, or get the word pledges totally out of your vocabulary. Don't even use the word pledge. I mean, always call it grant, because we don't want to get into the habit of calling potential pledges and then running into the problems that we saw in 2017-73, where the IRS, whether or not 2017-73 pledges are enacted, the IRS goes back and says, well, you paid a pledge because you called it a pledge. So the first thing I would say to foundations is, as I mentioned, get that out of your vocabulary. Don't ever call it a pledge. Call it a grant. And always say that the grants are conditioned upon approval by the board and amount of the funds in the fund. You don't want to have the community foundation responsible for for example, a multi-year pledge or a multi-year grant if that donor advised fund doesn't have the requisite amount to cover that grant. So once again, it's important to call it a grant, not a pledge. So going forward here, notice 2017-73 change any rules with respect to DAF distributions and receipt of tickets or other benefits by the donor? And the answer is no. They reference current law, which talked about bifurcation, and that basically the general opinion is that distributions from DAFs for the purchase of tickets to charity, sponsored event, or to pay for membership fees is an impermissible benefit under 4967. So this is what the council has always been telling members, how donor advised fund grants should not be bifurcated, and I think this kind of just confirms that belief that the council has had historically. Moving forward, is Notice 2017-73 going to make going to change how we make DAF grants to small charities that could be in danger of tipping? And the answer, unfortunately, is possibly. So the notice requests comments regarding proposed regulations to address the potential use of DAFs to circumvent the public support limitations, and as a result, possibly circumventing the excise tax and other rules applicable to private foundations under Chapter 42 of the Code. So for some background here, for an organization described in Section 501c3 to be considered quote unquote publicly supported and thus classified as a public charity pursuant to Section 170B, that organization must receive a substantial part of its support from either the government or direct or indirect contributions from the general public. Now, typically, an organization that normally receives the number is 33.5%, 33 1/3% of support from the government or direct and indirect contributions from the general public will be considered publicly supported. However, the Treasury places limitations on amount contributions from any one individual, a trust, or a corporation. And this is the 2% limitation that goes into that public support equation, determining whether an organization is publicly supported. Now, currently, this 2% the small grantees of community foundations. But what I will say is that I have seen some stark oppositional comments in this regard regarding this issue of 2017-73. And if you haven't, and if this affects your grantees, it might be of benefit for your foundation, as Brad mentioned, and as I intimated, that the IRS and Treasury may still be accepting comment. And if this is something that would affect your grantees, maybe this is a chance for you and your foundation to submit a comment regarding this public support issue. So going further, and as I mentioned, we're just going through these questions that Suzanne brought up and discussed during Dallas. So it's fairly straightforward. And one of the questions they had was explaining the difference between a fiscal agent and fiscal sponsors and whether the foundations should be doing these. So let me tackle the first question there, or the second question there, and should the foundation be doing these type of arrangements? And as I always tell members when I talk to them, while it is important to follow all federal, state, and local laws, it is equally imperative that you follow your own rules. So in this regard, you want to consult your organizing documents like your bylaws, articles of incorporation, or policies. Are you prohibited from serving non-charities? Can you make grants to non-501c3 organizations? And has your organization, has your foundation in the past engaged in these fiscal agencies or fiscal sponsorships in the past? So let's go through these. So once you have established that your foundation can get into these kind of relationships, let's explain the difference between a fiscal agent and a fiscal sponsorship. Going forward. So in a fiscal agent, in the law of agency, it states that the agent supports the principal. And if you call yourself a fiscal agent, that you are supporting the project, it looks like, by appearance, it looks like that the community foundation is the agent of that non-charity. And so that's why we want to get away from calling it a fiscal agency, because it is the reverse. It should be that the non-charity or the group that is seeking sponsorship from the community foundation should be acting in conformity with the rules and regulations set forth by the community foundation. And that's why, following the next slide, fiscal sponsorships, if this is what you guys actually do, is the more appropriate way of an arrangement. And this is where the sponsor, i.e. the community foundation, retains the ultimate control over the project. And it basically becomes a way that the foundation can use the charitable dollars for a charitable purpose. Now, one of the issues here is making sure that the monies granted for the fiscal sponsoree is not earmarked for the fiscal sponsoree, because then you get into the issue of whether that money is the irrevocable property of the foundation, and we can get into that more if anyone has questions regarding that. But generally, to tie a bow around this, the Council on Foundations strongly recommends that in reference, we call it, and also in agreement, we call it fiscal sponsorships, not fiscal agencies, only because of the whole agency law that is associated with agencies. Going forward, can community foundations make grants to organizations that are not 501c3 charities? And the answer is yes. I mean, this might be old hat for a lot of you, and for those of you who have been in the community foundation game for some time. And so the general answer is yes. But going back to my previous slide regarding fiscal sponsorships, you always want to ensure and do your due diligence whether your bylaws, whether your articles of incorporations, whether your policies even allow you to make grants to non-charities, because I do know of some community foundations out there whose bylaws, policies, and articles of incorporations prohibit them from making grants to non-charities. But if you are not in that camp, if you're in the camp that allows your foundation to make grants to non-charities, then yes, under this slide you can. So for example, 501c4, so the political activity organizations, C6s, those business organizations, and other C organizations, you can make grants to foreign organizations, for-profit companies, and even organizations that are still pending their 501c3 status. But a note that Suzanne has made there at the bottom, you need to ask, what type of fund is making the grant? If it is a donor advised fund, then expenditure responsibility is required. If not, and this is kind of a great line that she uses ER light, so expenditure responsibility light, and we'll get into that here in just a second. I just do want to make one comment here. The reason you have to ask what type of fund is making the grant is because of expenditure responsibility. Expenditure responsibility, and as I mentioned, we'll go into this even deeper, is a federally mandated procedure for private foundations. Now, if you are not a private foundation, then you need not worry about expenditure responsibility unless you are dealing with donor advised fund. And in that case, the donor advised fund rules reference 4945H, which is the expenditure responsibility rules of the private foundation code section. Let's go forward. So grants to non-charities from other funds other than donor advised funds, as she mentioned, ER Light, is really expenditure responsibility, but not to the highest degree. So you still want to do a grant proposal or an application. You still should request a budget. You should still have grant reports, receipts, and invoices as well. The key is to document your money and make sure it was used for charitable purposes. And here's a question that I was really glad to see asked by foundations, because I get this question all the time. Does our board have to approve every grant? And the answer, in typical lawyer fashion, is that it depends. Now, there are some of the issues that Suzanne had put forward regarding whether your board needs to approve every single grant in terms of the fiduciary responsibilities, delegation to staff, grant agreements. But I think the second point there is that the board needs to know what the community foundation is doing. And so if the board is comfortable with the staff and the officers and what they are doing, then generally I don't think that the community foundation board needs to know everything that's happening. But here's the rub. In my talks with treasury officials, when referencing a specific issue of a foundation or like an audit, the IRS, they never inquire, what did the project manager know? Or what did the CFO know? They want to know if the board was aware of this issue. So that's why it really depends on whether in your risk tolerance, in your foundation's risk tolerance, you think that the board needs to know about this. Another point that I want to make about what the board should know is I've been seeing a lot of community foundations recently getting into not the business, but kind of getting in the practice of extending loans or lines of credit to grantees instead of just making grants. Now, the problem I have with that, and and something that the board definitely needs to know about, is that I think from an MIFA, Uniform Prudent Management of Institutional Funds Act point of view, I think that in the case of, let's say, a default by one of those grantee organizations that either taking out a line of credit or a loan, if they default, I think under MIFA, under the board's prudent management of institutional funds responsibilities, they would have to enforce that and collect. Now, the problem with that is anytime, in my opinion, that a community foundation goes after a grantee, that just sets up a really bad public relations score. You know, anytime a community foundation is in a lawsuit that says community foundation versus XYZ charity, that just looks bad. So that's why it's always important to structure these kind of loans or lines of credits appropriately, and also question whether and what you do in the case of a default of a grantee, if it's a line of credit or a loan. Okay, moving forward, the last question here is, what is the difference between expenditure responsibility and an equivalency determination? Now, this is a big issue for foundations that are in the global grant-making space. The difference here is this is expenditure responsibility. As I mentioned, it is the federally mandated procedure under IRC 4945H. And below there are the 5 basic steps: the pre-grant inquiry, written agreement, separate accounts, regular reports, and 990 PF reporting. A great point that Suzanne has on the slide is that a community foundation is not an insurer of the grantee, and that's important to note, because under the Treasury regulations, and you could write this down if you ever want to read it, it just says that under 534945B1 that you are not an insurer of what this grantee does. So even if a grantee, I mean, you go through the whole expenditure responsibility and you do everything properly, but this grantee, for some reason or another, misinforms you or does something inappropriate with the funds, you are not an insurer of that grantee that the funds will be used for charitable purposes. You just made a reasonable effort to ensure that the oversight and procedures were followed for making grants to a non-charity. Now, the difference between that and equivalency determination is that this is for determination that a non-U.S. organization is the equivalent of a U.S. public charity. Now, I do want to make one point, is that, you know, while I talk about non-charities for expenditure responsibility can also be used for global grants. It's just that the community foundation can make a decision whether they want to use an equivalency determination or an expenditure responsibility procedures when making grants globally. And once again, the third point there is the point that you should note. An equivalency determination provides an opinion regarding the organizational and operational status of the non-U.S. organization and whether it meets the public support test in the U.S.
Brian, I think this might be a really good point to let people know that if they do have questions, happy to take those, and we'll try to filter those through as we have a few minutes left. I also wanted to, while we give people a chance to formulate their questions, you know, say on this equivalency determination, this is where our broader council staff, Natalie Ross, who
absolutely
certainly has strong expertise in the global grant making space, has led several of our research projects in partnership with Foundation Center and others on what are U.S. community foundations doing around grant making. And I think this is important to say that those studies, what they reveal is that there is an increase in the amount of grant making that's going out of the country. And it's happening, yes, at the big foundations like Silicon Valley, Cleveland, Boston, Seattle, but it's also happening in pockets across the country where you see multinational corporation links to places like Mexico, Canada, and abroad. And you see there's an interest in corporate funders who want to participate in grant making through the community foundation a little bit more broadly, but you also see it on an individual level where families want to support charities. And Natalie has an abundance of knowledge of who is doing this work well. And as well, we can't forget that we have community foundations across the globe, and they are great conduits by which we can grant to and let them do the local work that our donors are interested in doing. And it represents, I might have already said, but it represents about 6% of the grant making in total from U.S. community foundations is going abroad. So that's a pretty strong number. It also suggests that 94% is still staying local, so that's important as well. But we can't overlook this component, and if you get tripped up with this, we've got a great staff to lean on for that. So still no question. Yeah, go ahead.
I'm glad you brought that up because, just as I mentioned, Brad has great street cred with respect to community foundations. Natalie, the same way. I mean, with respect to global grant making, just great staff, and I'm very fortunate to be a part of the council today.
So at this point, we'll give people a few more seconds if they want to ask any questions. You've brought up a lot of really good information, Brian, and just a reminder to folks outside of talking about the expenditure responsibility versus equivalency determination. Brian also brought up about questions about boards approving grants and to what level, and we can certainly talk about some processes that just help streamline that. A lot of times boards will ratify the grants that go out the door so that they've at least seen them, even if it's after the fact that the staff has already administrated them. They ratify the list of grants so that the board is aware. We've raised questions about granting to organizations that are not 501c3s, if that's something that you want to talk about. My favorite, the difference between fiscal agencies and fiscal sponsorships. And certainly beyond just what's the difference and should we be doing these, there's a whole lot of questions that Brian didn't answer around the business model of fiscal sponsorships. I think they are very advantageous and important to community engagement, but they have to be done in a way that is prudent, and we have to be fairly frugal, and we have to pass those costs on to the entities that we're serving. A reminder, we talked about the notice from the IRS around donor advised fund grants to charities, as well as to distributions associated with tickets and other benefits to the donors. We've talked about pledges coming from the DAFs, and we've talked about tax reform in general, as well as UBIT. I believe that might have been it. So if any of those things triggered questions from all of you, would love to hear it. At this point, Brian, the one question that we've received is that we might go ahead and start talking about while other people think about this is, are giving circles, organized committees advised, fiscal sponsorships? How do we classify giving circles from a fund administration standpoint?
Well, from a fund administration standpoint, I always see it as who approves the committees, right? And because the community foundation always has the dominion and control over those committees, and so I would say that I would. What was the final question of that? The final part of that?
Just how are giving circles organized? Are they, when they're committee advised, fiscal sponsorship? Let's talk about the fund administration and how they get structured.
Well, the way that I've dealt with them is that really they go through that committee, and then the community foundation would basically approve it. I see it as like a field of interest. I mean, do you agree, Brad?
Yes, I tend to believe that the best way to organize a giving circle is field of interest, and it does have an advised committee. Now, you may not be listing every single giving circle member as an advisor. Typically, what you want to do is set up a smaller group who is sort of your lead advisors and lead organizers, and ultimately you are taking the advice and recommendation of them on behalf of the broader giving circle, regardless of how they process that and come to decision making. But a field of interest is by far the best way to organize that. It's not necessarily a fiscal sponsorship unless it is a completely separate project or group. Would you agree with that, Brian?
I absolutely agree. And this just demonstrates the street cred of Brad. I mean, I lean on him all the time with respect to the intricacies of how foundations actually run these things, because as I mentioned earlier, I mean, I could talk about the legalities of this every day, but Brad, I mean, you've seen this in action. And so this is why it's great that we have you on staff.
Well, I think to that point, around the fiscal sponsorships, the only, there are plenty of giving circles that do run fairly independently. And actually, I would say that if you're a community foundation that is fortunate enough to have a giving circle that is independently operated and ran, maybe there's some value there because they're controlling their own costs and so forth. But they can be very expensive ventures. And while they are democratizing philanthropy, that you have to really understand the strategy that you're deploying. You have to acknowledge that they may be a loss leader in terms of resources, and particularly costs associated with them. But at the very least, whether you structure it as a fiscal sponsorship or a field of interest fund that has costs associated with operating that giving circle, I think you have to understand how it can operate net neutral, meaning it covers its own costs. If they're raising X amount of dollars, $100 or $1,000 per participant, a portion of that must pay not only the fees of the fund, but they also must pay the associated costs of the events that these giving circles love to host as social aspects of the fund. And there was a follow-up question to that, Brian, that says, is it not a committee advised fund? How is it a field of interest fund? And so, Brian, you're welcome to answer this, but essentially a field of interest fund can have advisors to it. And Brian, you want to give a little more clarity on that?
Well, yeah, it could have advisors. A field of interest can have advisors, but the rub here, and Brad, correct me if I'm wrong, the rub here is that the community foundation has the discretion over the committee members, and they approve them, because otherwise you would have a donor advised fund under 4966, because under donor advised fund 4966, the donor advisor or advisors have the advisory privilege, and they could name those advisors in that regard.
Correct, and then you get into issues of paying expenses associated with the advisory group. And so typically that's why I have seen community foundations want to set up giving circles as a field of interest. The field of interest may be very broad. It may be associated with millennials. It may be associated with women interests. It may be business interests. So that is particularly your field, or your field may be geographic in nature.
Right, or a geographic affiliate. Yeah, right, absolutely. And that's a great point you made, because as a donor advised fund, the council has always recommended against paying fees, because donor advised funds should be making grants for charitable purposes. And so sometimes these funds.
To clarify there, Brian, you mean we've discouraged paying expenses?
Expenses. Expenses. And so and instead making grants, charitable grants. And so if you're making, go ahead.
Yeah. Well, and so to clarify to our audience, a field of interest funds can pay expenses. It would just be an expense of the fund. And scholarships are the same way. Scholarship funds can have expenses associated with them. You may have expenses associated with online grant applications that are specific to scholarships. You may have award ceremonies that are specific to scholarships, and the funds can pay that operational expense. The community foundation itself does not have to pay. Now, the argument that you're going to get into is, what's the difference between what the fee is paying for that you assess on a fund and what expenses are actual expenses of the fund? And so there does need to be a clarity and a principle of how you choose to operate expenses. But many times, expenses far and wide exceed the administrative burden of a fund, and therefore expenses are direct expenses, and so they are interfund accounted for within that particular component fund as expenses to the fund. So great questions around giving circles, and certainly we can always talk about giving circles all day long, but checking to see if there's any other questions as we wrap up. We have just a few more minutes before we close out. While we wait to see if there's any more questions, hopefully we answered the giving circle questions correctly. If not, I always highly recommend legal@cof.org, and we can certainly continue to work through that. But want to remind people the Legal Matters workshops are happening across the country. You can find them at our event page, cof.org, under events. You can see the full list of professional development associated with community foundations, which includes Legal Matters, as well as our Community Foundation Excellence courses, which are also great training tools. So don't believe we have any more questions coming in at this time. So Brian, I think it's fair to say that we can close out. I don't think we would be remiss if we did not thank Kelsey Gerber, who is at the council. I'm sorry?
Yeah, thank you very much, Kelsey.
Yes, Kelsey is at the Council on Foundations operating this webinar, while Brian and I both are remote. Brian is in Seattle and I'm here in Indiana. So thank you, Kelsey, for your help in organizing this. Thanks to all who participated. Brian, thank you, as always, for your expertise and participation. And we hope everyone stays safe and be well, and reach out to us anytime that we can be help here at the Council on Foundations. So thank you.
Thanks, everyone.